Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, April 29th. It's Trump's 100th day in office, 100 days of uncertainty, 100 days of escalating trade tensions and weakening investor appetite, but minor hints of potential de-escalating since the last couple of days. So the latter keeps the sell-off contained in US equities. The European stocks look better a bit, while the US dollar remains under a decent selling pressure, and pullbacks that we see in gold prices continue to whet the dip buyers' appetite. So we will talk about all that today, but before we go, please keep in mind that opinions that I will be sharing here in this video are my own and this is not financial advice. So the week started on a slightly positive note for the European equities on continued expectation that the disinflationary impact of Donald Trump's trade policies on Europe will allow the European Central Bank to give ample support to the underlying European economies if inflation allows, but it looks like it will allow right now. But sentiment was much less bullish for the US equities on Monday. That actually saw an initial drop on rising inflation expectations for the US economy due to tariffs and worries that any Fed support would actually be quite limited due to a heating up in inflation dynamics. And indeed, we see all over the news and all over the posts that we see on social media how Chinese are reflecting almost all of their import costs onto their clients. Some actually out there think that the tariff impacts will be temporary. Some, however, including the Fed members, actually start thinking that the impact could be somehow longer than just a one-off jump in consumer prices, while many continue to hope that Donald Trump and his administration have no choice but to dial back their tariffs and their threats as the rest of the world showed much greater resilience to Donald Trump's tariff attacks, with China in particular appearing ready to fight to the last time. Now, the good news of today is that it's been a few days that we didn't hear fresh attacks by Donald Trump on the tariff front. It feels like he's been obliged to slow down the pace and the intensity of his trade attacks on the rest of the world and even on China. The bad news is that there is no clarity regarding the tariff situation at all, and we tend to forget, but the best outcome would be that the US would keep the 10% universal tariff, so the 10% tariffs for everyone, even if the negotiations go well and lead to a favorable output with some trading partners. But anyway, for investor mood, three things matter a lot right now. One, well, no news from Trump is good news. It means that he and his administration are softening their tone. Scott Besson, for example, says that they will be leaving China aside for a moment and concentrate their efforts on other negotiations for now. But there is a clear reluctance right now to further escalate the war on the Chinese front. Two, a dovish shift in Fed expectations would be more than welcome for investors, even though the Fed can't do much if inflation in the US picks up momentum. And three, well, the company earnings must live up to expectations, eventually and ideally do better, and forecasts shouldn't sound too gloomy either. But unfortunately, on that front, the news are not brilliant, mind you. Bloomberg economics team, for example, warned that a 22% tariff model, which is quite reasonable, would lead to a 7% contraction of the S&P 500 companies' net income in 2025 versus the current estimate of 12% growth. So there is some more to decline on that front. Some say that a softer US dollar should support the US company earnings, but tit-for-tat tariffs from the rest of the world could well eat into that margin, mind you. Nvidia, for example, fell 2% yesterday in a relatively calm session for the other companies on news that the Chinese Huawei Technologies will be testing a new chip to replace its Nvidia chips. Now, one question yesterday, speaking of the currency valuations, was the impact of currency valuations on stock prices and stock indices. Now, the answer is, well, never very clear, but there tends to be a negative correlation between the two, between the currency valuation and stock valuations, as cheaper currency allows investors to buy the stocks denominated in that currency for a cheaper price. So it means that when sterling, for example, eases, when sterling weakens, you would expect the FTSE 100 index to see a higher demand from international and foreign investors. But this relationship is not always clear, unfortunately. It really depends on the drivers of the market moves. This year, for example, euro and sterling have been rising against the US dollar on expectation that the US economy will crumble quite fast, while the European economies will post a weaker slowdown than the US economy, and the inflation outlook between the two continents would allow the European central banks to give support to their economies, which would be harder for the Fed to do due to the rising inflationary expectations there. As such, the rising currency valuations don't necessarily hinder the European equity rally these days. It is, however, interesting to buy on weaker currencies and hedge against the currency risks, if you want my honest opinion. So that's something that the US investors have apparently omitted to do over the latest rally in US equities. However, in fact, less than a quarter of the S&P 500 trades were hedged, according to the latest views, relying on the fact that the US dollar would gain to counter a part of the equity losses in case of panic. But not this time. So that means that international investors are not only losing on the S&P 500 sell-off, but also on the fact that the US dollar is weakening. Now, today is Trump's 100th day in office, and he will go down in history as the US president who actually triggered the most unnecessary and stupid trade war of history and led to the worst start in stock market since 1974. On the other hand, while US consumer sentiment fell to one of the lowest reads on record, and the long-term inflation expectations for the US economy actually spiked to the highest level since 1991, and the US economy has certainly gotten an unnecessary hit from the tariff uncertainty, as well as the US GDP growth is expected to have dropped from 2.4% in the last quarter of last year to 0.4% in just 3 months, while the US dollar is losing its safe haven and reserve demand status. So, well, it's quite not so well for the US assets these days. The dollar's misery, on the other hand, makes gold shine stronger than ever. The price of an ounce actually posted lower highs in the past 3 trading sessions, but not necessarily lower lows. So the price dips that we see in gold could actually still be interesting opportunities to buy gold as risks persist and central banks keep buying gold to replace maybe their US Treasury holdings. But for those who actually missed the latest gold rally, silver, that lags beyond by historical means, could be an interesting option on expectation that the mint ratio, so the ratio between gold and silver prices, would decline toward the 80 to 90 range at least, without, however, a significant downside correction for gold prices. Now, another interesting play for those who missed the recent gold rally is gold miners. The latter are actually seen as a leverage bet on gold, as higher gold prices in the market actually boost the revenues of these companies, their profits, and investor enthusiasm as well, leading to higher miner share prices, often by a larger multiple. Because looking at the numbers, gold, for example, rose around 42% between August last year and April this year, while Frenilo, for example, rose more than 100% during the same period of time. And for gold itself, the bulls remain strongly bullish right now, based on the fact that the factors that actually push gold prices this high, so the trade and the geopolitical tensions and increased central bank and retail buying, well, these factors remain intact, and some actually say, they point out that the latest gold rally of just 40% is still far from 1979's 120% rally. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.